on a panel here to talk about the globalisation of covered bonds, which kicked off earlier this year. We had the Basel Committee came out with some good news on the covered bond market. Maybe I think I just get everybody first to introduce themselves on the panel. I'm Bill Thornhill. I'm editor of the covered bond section of Global Capital. And if you'd like to introduce yourself.
Okay, Jakub Niesłuchowski, PKO BH, Warsaw, Poland. I'm CFO responsible for covered bond issuances.
I'm Mike McCormick, head of covered bond origination at Credit Suisse.
I'm Jerry Marlette. I'm with Mayor Brown in New York. I've been working with North American covered bond issuers since 2006.
I'm Cristina Costa. I'm in charge of covered bond research at Societe Generale, and I'm also a member of the ECBC steering committee.
My name is Colin Chen. I'm working at DBS Bank. I'm responsible for covered bonds and ABS, and I'm also the chairman of the Global Issues Working Group at the ECBC.
Great, so we're going to kick off with the first question. What did Basel say about covered bonds? Mike?
Sure, so I guess everybody was a bit surprised in December of last year when Basel put forward new rules for standardized risk weights, and for the first time, covered bonds were recognized as a separate asset class on the global scale. The rules were very similar to what we have today in Europe, in that they allow covered bonds to have approximately half the risk weighting of senior unsecured from the same institution. It is referencing ratings. They kind of, I guess, borrow what we call the UCITS definition in Europe, which is to define a covered bond as something that is subject to special legislation. It is something that has priority claim over assets that are defined in that law, and there's a requirement to top up those assets to make sure that they're always able to satisfy the claims on the liabilities. They also layered on top of that some of the requirements that we also have right now in the CRR, which is LTV requirements for mortgages of 80% and 60% for residential and commercial. There's a 15% limit on exposure to financial institutions, which is also something that we have in the CRR. And then there's some rudimentary disclosure requirements, which are something that the banks have to at least disclose semi-annually, outlining what assets are included, whether or not there are any delinquent assets, et cetera. I guess two things that were maybe a bit different than we're used to right now in Europe is they had a 10% minimum over-collateralization requirement, which was kind of on a nominal/voluntary basis. We can talk a bit about that later. And they also limited the assets to mortgages and public sector effectively, whereas in the EU, obviously, we have ships in the CRR, and there's discussions now about including other asset classes as well.
And how would you say that is compatible with what the sort of Brussels version that's potentially going to be coming out in terms of the directive and what it is now?
Well,
Christina.
We don't really know what will be coming out because we're in different parts of the stage. The Commission proposed the directive and regulation back in March. Then the Council has been having a look at it, and just end of August we had the Economics Committee at the European Parliament publish their views. What is very positive in the Basel III is that it proposes to grant preferential risk weighting of covered bonds, not just EU, but across the world, as long as they abide by the rules that Mike just mentioned. And this would set a really level playing field and work towards the topic of this panel, globalization of covered bonds. And so I'm hoping that as we go forward now, to put together the EU directive, now this is supposed to apply only to EU covered bonds. It's true that the proposal in the directive is also maybe in terms of eligible assets could propose something a little bit wider than just mortgage public sector in terms of other high quality assets, whatever that might be. But beyond that, this is meant to only be a framework of covered bonds applying only to EU or possibly EA covered bonds. In terms of third country covered bonds. The Commission's proposal was to say, well, we're not in a position to assess third-party equivalence, so we might give ourselves a period of possibly up to 3 years and do this together with EBA, even though they haven't really said how this would go about. Now, in the Parliament's proposals from what has been published recently, they view that this 3-year period is too long and that we should have an equivalence regime as early as possible. And I think this is what people like myself and possibly Colin also share. We have covered bonds is an increasingly global product. It's good to have a similar rules that we've been working around the years. But it would be very detrimental for issuers and the investor base not to know that either what they hold already in their books is really a covered bond, or whether what treatment it will have, what will be the capital treatment, will be LCR, what happens with, and I'm looking at gentlemen around the UK, what will happen with UK covered bonds, now preferential treatment in the future, maybe what not. So I'm hoping the Basel III proposals will go in the step in the right direction towards level playing field.
So Mike, just quickly back to you now. I mean, it seems like the directive is potentially going to be quite detailed, yet on the other hand, what Basle's proposing is probably somewhat different. Can you just highlight potentially what the differences might be there between what the directive is potentially going to say and what Basle is saying?
Yeah, I think maybe the biggest headline difference I mentioned at the beginning was the over-collateralization requirement in the Basel rules of 10%. I think the important thing to keep in mind there is that the way it's framed in the Basel paper is that it's an amount that doesn't necessarily have to be required by legislation, but it's one that has to be publicly disclosed as being met over time. So the way I interpret that is you may not by law or by contract have to keep 10% over-collateralization in the pool to qualify for the risk weighting, but you at least have to have it in there on a voluntary basis, and it has to be shown in your investor reports as being there consistently. So I guess that's one difference. I think Christina already flagged that the EU rules are likely to be a lot more detailed. So if we take an example of things that without going into too much detail of the directive, but there'll be a lot more detail on liquidity requirements I would expect in the final directive on covered bonds. There will be more rules around maturity extension, specifically when can you extend and when can you not extend. And I don't think it's likely that the Basel rules will ever evolve to that much detail, or at least they're not in that form yet. So if we're thinking about what the future could hold, if we do have an equivalence regime, which I think most of us are hoping is in place and is what seems fair, given that the EU has been promoting this product globally, there should be a framework whereby non-European Union covered bonds could qualify as covered bonds under the new rules. Those banks that are seeking to do that are going to have to go through a longer process and tick a lot more boxes to qualify for the EU rules than they might in their own home markets. Conversely, some of the European issuers who might want to be issuing in the future into other markets and benefit from that preferential risk weighting, if that's what the local regulator in a given country might allow, might find that they don't have enough OC to actually qualify for those rules, which is interesting because we do see OC levels going down. Or if we have somebody who maybe has shipping loans or other asset classes that they use, they might not have that access outside of Europe, which is probably okay because it doesn't cover most of the programs, but it'll be an interesting dynamic.
What do you think that actually means in terms of, I guess, for issuers doing deals out in third-party countries? Is that beneficial for them? Do you think that's going to increase the likelihood that we'll see more issuers coming to the market?
Well, I guess the first thing to keep in mind is that these risk weights don't come into play until I think 2022, so it's still a long way off. And there's probably other things that you need to see in local markets elsewhere for the investor base to really grow. Having domestic issuance is one thing. Other beneficial treatments for insurance investors, for example, or maybe better LCR recognition is another. And so it's a step in the right direction, but I don't think it's going to immediately mean that we see the global market and covered bonds expand too much right away.
And on that note, I've got a question for the audience. If any of you have got your apps, managed to get your apps working, there's a question which I have, which is, and maybe we can get this up on the overhead at some point, when will non-EU regulators of existing covered bond regimes reciprocate EU rules in terms of reduced risk weights and LCR eligibility? At some point that will come up on the screen, hopefully, and you'll get a chance to vote on it. In the meantime, I'll just take it over to Colin. What's your view on, do regulators in Singapore, for example, do the regulators in Singapore have to adopt this? Do you think they have to adopt mutual recognition of each other's, we get this level playing field?
Well, I guess Singapore is a reasonably new jurisdiction as well, and much of what has been put in place either mirrors very much what the EU has and the European jurisdictions have in terms of a framework, in terms of legislation. So with new jurisdictions, I think where the key issues would be how would regulators institute or promote the covered bond product. And if we do our work well enough globally as market participants, then the alignment of the covered bond product should be harmonized with what the EU is actually pushing forward on. So from a Singapore perspective, again, I'll take a stab at answering that question. The Monetary Authority would subscribe and prescribe rules by the Basel Committee. And once they have come up with the covered bond, the regs in December 24th, last December, very quickly there was a consult out now on how would then that be put into the national interpretation of the rules pertaining to covered bonds. So the mutual recognition is such that if any of the Singapore institutions purchased any of the European issued covered bonds, and so long as they met the ratings requirements and the product requirements for what is a principles-based definition of a covered bond, then they would be eligible for a similar LCR treatment, which would be level 2A. We have never had the prescribed preferential capital treatment, and with the Basel Committee coming up with that, that has thrown out a benefit, something that we are quite pleased about. I think the only issue is how we actually work it through legislation at this point.
I mean, you don't have the preferential capital treatment. Does that potentially lead to, if you don't have it in Singapore and you do have it in Europe, does Europe need to recognise, I mean, could that potentially hold back European regulators from lowering the capital charge for Singaporean deals if the Singaporean regulator hasn't cut 20% to 10%? Chen, Colin, or Mike?
I might make a comment first. I think if you look at it, how it's transpired over the last 3 to 4 years, the preferential capital treatment was accorded for only EU domiciled issuers, EU and EEA domiciled issuers. So level 1A LCR eligibility, preferential capital treatment, this was in the domain of the EU and EEA issuers. So it's not something that the non-EEA jurisdictions were part of, although we would have loved to be given the same treatment, but that was not something that was being debated at that point. So fast forward now, we are in this environment where we're talking about harmonization, equivalence. I think this is where the discussions and the devil lies in the details. How do we actually implement those new harmonization efforts?
Has it given you an excuse to go knocking on the door of the Monetary Authority of Singapore?
I think it's quite the reverse here, actually. The Monetary Authorities has summoned.
Oh, really?
I hope they're not in this room, but anyway. But the conversations are such that, how do we then, first you come up with the global regs, and now it's up to how the national interpretation of the regs would be and how it cascades down into the legislation. And
Jacob, from your perspective, from the Polish perspective, I mean, you're pretty much harmonised anyway, aren't you? So does it really does it make any difference? Does the Basel news make any difference for you in terms of what's happening in terms of the risk weights and the liquidity eligibility that you have already?
So here we as a EU member, of course, we are, and also after the change in law in 2016, we are very much aligned with the European benchmark practices. But here we are carefully looking at the development about the directive and CRR proposal concerning covered bonds, because on the one hand, we are discussing today that the Basel Committee is going in the direction of preferential treatment of covered bonds in terms of, for example, risk weights. And we, for example, are concerned with the latest proposals concerning increasing of risk weights for extendable maturity covered bonds. So this structure we have in Poland. We actually were developing this also with the discussion with rating agencies, regulators, and just to propose and have the very robust legal framework proposing very safe, secure, covered bonds. And here, in our opinion, we achieve it. So there is, of course, always the discussion concerning extendable maturity covered bonds, but
Hasn't happened yet, though.
yeah. So in our opinion, okay, the refinancing risk is lower. On the one hand, on the other hand, investors can have a higher recovery rate, of course, on the expense of time. On the other hand, and from my perspective, the increase of risk weights, as we saw in the latest Bernd-Lucke proposal, which gives additional 20%, which makes 30% for our covered bonds. And we know that preferential treatment is key for covered bonds to be by, for example, for the banks, which when I look on current distribution of our investors, 40% is taken by banks, which are buying for the LCR portfolio.
That's for your Euro deals?
Yes, for Euro deals.
But not your Polish deals?
Not Polish deals. For Polish deals, actually, we have different situation. Actually, banks are not technical problems. In Poland, actually, banks are not buying covered bonds. The reason for that is banking tax. So maybe I will not dive into details, but generally that's the reason.
That's not very harmonised, though, to put a banking tax on, covered bonds internally. That's preventing, bank investors internally from buying each other's covered bonds.
Actually, it's a tax on assets, not only on covered bonds, but, for example, treasury securities are tax deductible. So banks simply are buying government bonds instead of covered bonds, which are not compensating for the tax, taking into account the level of the spreads. So here, yes, on the Polish market, the banks are not existing. From the preferential point of view, definitely we look on the European market, and currently when you look on the split of our outstanding covered bonds, over 70% is issued in euro. And we know that's a very important market for us. That's why the proposal concerning increase of risk weights actually will lead, in my opinion, to limitation of development of the Polish market. Not only Polish, we know that the colleagues, for example, from Italy, from Netherlands, will have the same problem when such proposal will be in place, which, in my opinion, is not justified. Actually, the features of such instruments are already included in the rating. So if we base on ratings when we actually apply risk weights, credit quality steps, and then risk weights, we should stay with it. And ratings should reflect it. And additionally, we have additional safety buffers, OC, liquidity buffer, running the tests, etc.
I think, just one important point that you've made is that one reason to implement the CPT structure is to achieve the ratings that a lot of the regulations specify to get these risk weightings. And then to ramp up the risk weighting based on the maturity extension on the other side seems a bit unfair and would probably go against allowing emerging jurisdictions to access the European market.
And the whole point of the exercise was, I thought, to foster capital markets union. And in the Commission's impact assessment, they recognize that, okay, fine, so don't fix something that isn't broken, i.e. in Western Europe, which has developed markets, but they identified there were a number of jurisdictions in Eastern Europe that could benefit from maybe the covered bond toolkit. But if you put the barriers to entry too high, then you're back to square one to where you are today. So what's the point of going through all this legislative process and going through all the details and having regulators try and establish best practices when at the end, even if you do...
Whilst we're on that point, what's the US view of covered bonds, Jerry? I mean, they don't have a market, so to speak. It's all sort of foreign issuers issuing into the US. I think you get repo recognition, is it, for fan brief and nothing else? That's the only thing.
So I think I would say first the investor reception in the US I think has been very good for covered bonds. You're correct, we don't have any legislation in the US. I keep crossing my fingers and hoping we get there, but we're not there. And you are correct that the Federal Reserve for repo purposes recognizes only fawn briefs as covered bonds and no others, to the great consternation of the Canadian issuers, as you might imagine. For LCR purposes, the U.S. does not recognize any covered bonds as an eligible asset. In fact, they don't recognize any bank obligation as an eligible asset for LCR purposes. They're worried about contagion affecting the LCR. So it's covered bonds are not an issue for LCR purposes there. And I have no idea what the approach would be to the Basel preferential treatment for covered bonds.
And I know you've structured or helped structure a lot of deals for the Canadian banks, but how do you think the situation would be perceived over in Canada with Basle? Are there any reflections that you have?
Well, I think from the Canadian point of view, they have felt under existing regulations that they're at a disadvantage. They don't qualify as level 1 for their covered bonds. Don't qualify as level 1 for LCR. They don't qualify for preferential risk treatment. So it's something they've struggled with all along, and obviously it has an impact on their pricing. In a sense, they look at the covered bond directive as perpetuating that competitive disadvantage. 3 years to report, and we don't know how long till some kind of equivalency is determined. So it's a very uncomfortable place, I think.
Look, I think if we talk about the Canadians, we just refer that to some of the ones who are even newer to the game, the Singaporeans, the Australians as well. But we've noticed that a lot of the conversations with respect to risk weight and LCR pertain to from an investor's standpoint, not so much from an issuer standpoint. And going back again to where the regulators are looking at it is, what can we do? And if we do anything about it, can we help with the activity and the liquidity in the market? So at least from a Singapore standpoint, the conversations on risk weight are being looked at. But the reason for that is, would that help with the activity in the covered bond market from an investment standpoint, the liquidity book holding standpoint? LCR is a completely different conversation that comes, and I suspect that will take a lower order of priority when it comes towards legislating or coming up with the national rules with respect to moving to level 1. The Canadians do benefit from a repo eligibility of the ECB, something which the Australians and the Singaporeans don't. And that affects pricing as well. So, this wonderful cascade of who's right at the bottom, we understand how that feels.
So, Christina, if you try to sort of summarize where you see the main regulatory anomalies between Europe and kind of the rest of the world in terms of regions, do you have any insight into that?
Well, definitely, one size can't fit all because you have different banking regulations and solvency laws, history of banking crises and funding tools like in the US, Fannie Mae, Freddie Mac have a big role, covered bonds. Don't think they'll, even if we could, as hard as we could ever wish, they're still going to be the main player in the market. But I think things could be done to create a maybe better level playing field, and I think there is room for industry or market participants like us, and Colin as the chairman of the Global Issues Working Group, to help push forward and maybe, try and help the Commission and maybe the EBA and other counterparts, regulators, try and map out enough equivalence regime would be the right word, but at least map out, okay, if this is your wish list of what your ideal covered bond would look like and what would be the various ingredients for a magic recipe, well, we have good regulation in Singapore, in Canada, in Australia. There is role of carpal monitor. There is defined assets. What is missing? And then maybe identify what is possibly missing in the wish list, and then maybe go back to the regulator, see if this is something that they could easily fix or consider. One thing when speaking about Commission, they said, well, it's an assessment regime, but sometimes it's also about seeing how the local regulator also treats the local covered bonds. So the Commission has said to me, well, looking at Singapore, it looks fine, but when I see that MAS doesn't even recognize their own covered bonds for repo eligibility, why should I, as the ECB, fine, I recognize the Canadians, but why should I recognize the Singaporeans if they don't even recognize their own? So it's true that there has to be a two-way approach. And I know you're talking very heavily with MAS to try and...
They are looking at it, suffice to say. And it's a treadmill. It's a journey that we continue to take on repo eligibility, the conversations. And I'll take the opportunity to do a commercial break here. At the ECBC and the Global Issues Working Group, we've attempted to put together at least a comparison on a country-by-country mapped against the EBA's best practices for covered bonds. And we do have basically a table outlining the results of which jurisdiction actually complies, how much they comply with or how little they comply with the best practices. So without letting too much else out of the bag, please happily log into the ECBC website, or if failing which, I think the Secretariat should be available for a physical copy upstairs if you need to have a reference. But that's the starting point of trying to provide some color on equivalence.
Yeah, one thing maybe on the regulatory side that could change outside of Europe that might help promote more globalization is the encumbrance caps that we often see in other countries. I know that it's a very difficult conversation to have. It's something that most countries put into place when covered bonds are new and they're worried about depositors, but you have, I think, 8% in Australia, 4% in Singapore and Canada, and New Zealand, I think, is a bit higher. But the question is whether or not now that we have bail-in regimes or in TLAC requirements coming out in these countries, whether or not they also need that encumbrance cap. And if they didn't have that encumbrance cap, maybe it would leave room for some of the banks to be a bit more creative instead of just, always with the limited issuance capacity they have, always going to the euro market, maybe exploring other currencies that might be helpful. And one other thing that occurs to me, which is another area that EU might diverge more from the rest of the world, is on NSFR. So I think the way that encumbered assets are treated under the Basel rules makes it detrimental to issue secured funding to your NSFR ratio. And some wholesale funded banks find it difficult then to issue a lot. I would say maybe the Australians, for example, have taken note of that because it's already been implemented there. Whereas in the EU, they're relaxing that a bit more, which I think will give more flexibilities to the banks here to use the product. So question as to whether regulators should be thinking about that as well if they want to use that covered bond funding tool to fund their housing market.
What's interesting here is this discussion is all black or white. That is, we either have equivalency or we don't, and we're not going to get to that determination for 5 or 6 years. There doesn't seem to be any discussion of an interim position where you could say third country issuers who perhaps are rated AAA or AA would qualify until we've resolved the equivalence determinations. There is some middle ground in here we could talk about, it seems to me, that would not disadvantage everybody.
Can we just put that graph back up again and see what the results were? I think it came out with everybody sort of suggesting 2021, 38% 2021, and some people nearly a quarter even later than 2022. So not a lot of optimism there, but hopeful, I guess. So I wanted to move on to the next point, which is basically we've had pretty vibrant markets in sterling, Swedish krona, Danish krona, Norwegian krona, and so on. But it doesn't really feel like we've had very much issuance of Australian dollars. The US dollar market comes and goes. We haven't seen anything in Singapore in dollars. Just wondering, what is potentially holding local markets back? Colin?
Well, I think from a Singapore dollar perspective, all three of the issuers are deeply deposit funded. So there is really no, from a diversification perspective, there is no real benefit to be issuing a Sing dollar denominated covered. So from a strategic and from a diversification standpoint, the banks have said that we would look towards a foreign currency in terms of the denomination of the covered bond. Things may change if you're looking at the foreign subsidiaries who are incorporated in Singapore, who might want to have Sing dollar funding from a funding perspective. And that would change how the view in terms of raising Sing dollar denominated covers would be. As a firm, DBS has issued Aussie dollars. And I think from a Singapore bank perspective, we've issued collectively across euros, the US dollars, Aussie dollars, sterling. So we've built both currency diversification as a collective as well as maturity. We've built curves from 3 to 7 now. So in a short span of 3 years since we first issued.
Mike, why do you think it is that we haven't really seen local currency markets sort of picking up and getting going?
I guess in the markets that you mentioned, you also have very highly rated, so AA rated banks who can fund in senior pretty cheaply, so they probably would prefer to issue coverage elsewhere at a tighter level and not deal with relative value versus senior in their home markets, or maybe they feel like they're not getting paid enough for the collateral versus the senior in that market. Regulation is another thing. I think for me as on the DCM side, it's very hard, or it has been hard to pitch to Euro area issuers in particular the idea of issuing in another currency, even if the basis works, because and the investors are there, because swaps are also a bit of an issue, where we've seen regulation changes over the past 3 or 4 years that just make it very difficult and expensive to put cross-currency swaps and cover pools for some banks. A highly rated bank can do it and provide it themselves, it's fine, but if you're more towards the single A rating, you have to deal with the regulations like EMIR. There's LCR impacts of providing swaps to your own cover pool, or you then have to pay a third party to actually do those swaps, and then it will cost you more. And so people are less likely to do it, especially right now when they have the ECB bit. So I think swaps is one area where maybe in the future there can be more standardization or even clearing as a way of making it easier. I mean, I don't know you obviously have to do swaps into zloty to make that work. So.
Yeah, that's right. That's kind of challenge.
Yeah.
But here on our side, we see both local markets and Euro markets as a very important ones. Also give us some flexibility when mentioned swaps, cost of swaps are simply too high for us. For now, we are managing it. We are regularly issuing on bond markets, actually, Polish zloty and euro, but definitely it's important factor, and our swaps are also are not standard, which increase the costs. We actually apply the Moody's requirements in this place. We including them in the cover pool. That's definitely the factor which actually also impacts our decision concerning on which market and with what volumes we are actually issuing.
Just wanted to open this question up to the audience with our second question, which is, in the next 5 years, do you believe the best potential for growth in covered bond volumes will come mainly from either new issuers and existing regimes or establishment of new regimes, A or B? And while we're considering that, I wanted to turn the debate over to Jerry again, talk about the US government. They apparently have plans to move responsibility for low-income housing from the GSEs to the Department of Housing and Urban Development. What does that mean, potentially?
We have the curious situation in the United States where, as you probably all know, in the financial crisis, the government took over Fannie Mae and Freddie Mac. They did not take them into a bankruptcy receivership. Instead, they took them into a conservatorship, which is somewhat of a no man's land. And they remain in that position today. And the reason they remain there is because as is often the case, the Democrats and the Republicans can't agree on what to do with Fannie.
Yeah, the volume is, your mic is...
The same problem. Yeah. Technical problem. The main point of dissension between the two groups is around the support for low-income housing provided by Fannie Mae and Freddie Mac. So there was a recent proposal from the White House, it came out about a month ago, for a reorganization plan for the US government, to put some agencies together, to create some new agencies, to close down some agencies. And buried in there on page, I think, 75, is a plan for resolution of Fannie Mae and Freddie Mac. And part of the plan would be to move all of the responsibility for low-income housing into the Department of Housing and Urban Development, into a government agency, and have it as an on-balance sheet activity. That would free up Fannie and Freddie to simply focus on the secondary market for mortgages. I think that if they did that, that would remove all of the tension between the two parties on what to do with Fannie Mae and Freddie Mac. The big question, of course, is it ever going to happen? I think we have to wait and see if it's taken up into legislation over the next term. Probably, if we don't see anything by January or February, I think it won't happen. But it's an interesting development. And as part of the proposal, Fannie and Freddie would be privatized. They would no longer have support from the US government. They would be privatized as companies that would package mortgage loans and create mortgage-backed securities. And if they put in place first loss positions on those MBS, they could then apply for a guarantee from the US government for which they would be charged money. And that would open the mortgage-backed securities issuance business up to others besides Fannie and Freddie, and it would make it a very different market. In that environment, then, once the banks in the U.S. understand where Fannie and Freddie are going, it opens up the discussion of what's the best way to finance residential mortgage loans, and are covered bonds a reasonable way to one of the reasonable, alternative ways to finance mortgage loans. So if we've been stuck in this stasis for 10 years, it has to be resolved at some point, and this looks to be like a reasonable plan, but we'll see what happens.
But what do Fannie and Freddie think of this? I'd assume if I were them, I'm in a cushy position. I have in a monopolistic, in a way, position. Any proposed changes to open up to competition is not going to be very well received. I don't know have they openly given their views on the proposal, or have they hoped that people, unlike you, who've gone to page 75, most people haven't really gone through the first 10 pages.
That's a very good point. Fannie Mae and Freddie Mac over the last 30 years have been very big contributors to political campaigns for many senators and congressmen. So they have had a lot of influence in Washington. But the present situation makes everybody uncomfortable. The government has expressly guaranteed the viability of Fannie and Freddie. As part of that, they are sweeping all of the profits from Fannie and Freddie back into the Treasury. The stockholders for Fannie and Freddie are not comfortable with that. So there are a lot of people pushing for a resolution. For people who work at Fannie and Freddie, I think they'd like to keep it the way it is. So there are a lot of competing desires there.
So that would only really be a foundation stone to potential reform, but there would be roadblocks presumably further down in terms of the FDIC's, I think, is it approach to.
Yeah, I think the FDIC's concern is that the concern that the 4%, 8% limit you talked about. They're worried about encumbering assets that might be necessary for a resolution of a bank. Obviously, there's some middle ground there. Obviously, banks encumber assets in a lot of different areas, starting with central banks, with repos, with swaps. So there are a lot of different areas where assets are encumbered. And I think the FDIC would, and I've heard, that they would be comfortable with some kind of a cap. I had heard 8% as a suggestion, but nothing definitive on that. But that would address the concern.
Mike, what do you think is holding back local currency markets? I mean, you did spoke earlier on about it, but do you think that's something that is achievable within the next few years or not?
Yeah, I guess we talked a little bit about the swaps before, and that would be other issuers coming in to develop a market. I think the best way for markets to be developed is to have a robust domestic issuer base. So you were talking about issues that you have in Poland. With an unhelpful tax, I think those types of things have to really go away in order for those markets to develop robustly. And it's not just, we talked a lot about risk weightings here, but it's not just about risk weightings for bank investors. I think you want real money investors involved. I think you want insurance investors involved, and maybe even local central bank investors involved. And I think that's where you have already organizations like EBRD and other multilaterals who come in and try to kickstart the markets, and I think that type of activity really needs to continue as well.
Just wanted to again open up to the audience for the third and final question. What is holding back a thriving local currency covered bond market in non-EU countries? Is it A, not enough regulatory incentives for investors, B, no capacity to match pricing and size available in euros, or C, setting up covered bond programs is just too expensive for small borrowers. Just wanted to move on and talk potentially, while we've still got a couple of minutes, I think we're coming towards the end of our session, about prospects for non-European covered bonds beyond the sort of English-speaking areas. And I'm here thinking of your local market, Southeast Asia, really. How do you see that picture developing?
I think they're all English-speaking, but anyway.
Okay.
There has been, again, interest from both an investor standpoint as well as an issuer standpoint. So from a regulatory perspective, there is a push, or at least there's some intent and interest to develop an overall framework. If you look at some of, to just name some countries, Malaysia's central bank has been investing in cupboards, in euro cupboards. So has the Chinese central bank, so has the Korean investment authorities. So many of them have been exposed to the covered bond product. But they are now perhaps looking at providing a systemic, a diversifier and an alternative for the banks in the system to have access to a deeper source of funding and liquidity, and therefore considering introducing covered bonds. That process is not, and I suspect, not an immediate outcome, but that's a journey that we will all take. And I think within the Asia, not to mention just non-EA, but just in the Asia context, you'll probably be looking at a couple of new jurisdictions come on stream.
And sort of the one thing that I don't know if we've talked about this, but encumbrance, that was the big issue with MAS, 2% there. It's small, it's the lowest level.
4%.
Oh, okay.
2% was what they said during the consult.
Okay.
That's where we all fell off our chairs and we said, forget about that. But they said we'll increase it by 100%.
Do you think they'll change again on that?
Suffice to say, I think we are in the process of reviewing that particular number, how that moves and how the definitions of the composition of the calculation of encumbrance, that's something that's ongoing. So hopefully, by the next covered bond conference in Singapore, we might be able to have some updates on that.
We've heard a lot of encouraging news when we were in Vancouver earlier this year that the Canadians might look to change their encumbrance or the sort of level as well. So any views on that? Do you think that might happen sooner rather than later? Anyone care to speculate on when Canada might change its approach to covered bond issuance?
When I don't know, but I attended the conference in Canada in April, and I don't know if it was a gentleman from National Bank of Canada who said, well, I hear you. I hear about, but we do have concerns about asset encumbrance, but we could envision maybe possibly, throw this up to consultation, as having two limits. One for going concern, when everything's going okay, and another maybe stricter one for rainy days. So he says, don't expect me to all of a sudden double it from one to the next, but maybe we could consider taking some baby small steps, which could provide some leeway, which could allow smaller banks to maybe access the market.
And we're going to see hopefully some more Polish issuers join the market soon as well.
Generally, yes. So we have specialized banking models, so it requires banking groups to set up mortgage banks. So we get already three. Two of them appeared on the European market, us and colleagues from mBank. But other banking groups, three other banking groups now are in the process with Polish regulators, so ING, Santander, and Portuguese Millennium. So definitely in 2 years' time, you can expect more issuers on the European market. On the Polish one, most probably there will be earlier.
I think we've already overrun by a few minutes, so I'd like to draw this to a conclusion. Thank you very much for taking part in the panel today.
Thank you.